Hey everyone, I wanted to elaborate a little bit on what's going on with SoFi stock through its various business segments, including its credit card and invest products, its tech platform, and its strategic changes in its lending portfolio. So let's go through these one at a time and really try and understand what's going on with SoFi. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so one of the things that SoFi has focused on is attracting direct deposit customers. And these customers, they're focused on higher credit score customers. The median FICO score of the direct deposit customers that SoFi attracts are 744. That's on the higher end of credit scores. So they're attracting customers that manage their finances much better than average. Customers that don't borrow too much, customers that pay back their loans for the most part and operate responsibly. They don't have debt payments that are a large percentage of their income. And so this allows them more flexibility to borrow more, purchase more, and grow with SoFi. And so SoFi is noticing that with the customers that they're attracting, the overall debit transaction volume exceeded 1.9 billion in the quarter. That was up 20% from the prior quarter and a whopping 150% year over year. Now, that's a result of attracting these well-heeled direct deposit customers. So when you have a customer that joins SoFi and adds direct deposit, you know a couple of things. Number one, that customer has a recurring source of income, whether it be a job or a business that's attracting direct deposits into this bank account. So you know this customer has recurring income, which is always a good sign when you're a bank looking to attract the customer. Number two, you know that this is likely to be the primary bank account of this customer. If you have direct deposit with a bank, you're probably going to use that bank for your payments. You're probably going to use that debit card most often because that's where your check is going into. So you're going to use that debit card more often. Otherwise, if you want to use a different debit card from a different bank, you're going to have to initiate a transfer from SoFi to another bank, take an extra step. It wouldn't make sense for most customers to do that. That's why SoFi's marketing has been aimed at direct deposit customers. They'll give you a high interest on deposits if you have direct deposit. They'll give you a $300 sign-up bonus if you get direct deposit. So most of their marketing goes towards attracting these types of customers, and you can see why that's the case. So looking at SoFi's credit card and investment products, this is a loss-generating business segment. Those losses are nearly 100 million annually on a run rate basis. That means in the most recent quarter, it was roughly 25 million. And if you annualize that, that's 100 million. These are areas SoFi is willing to invest, willing to generate these losses because they feel in the long term, they will be money generating, profit generating business segments. They expect that these products will eventually contribute profit similar to their progress with SoFi Money. So that's why they're willing to absorb these losses in the near term, because they expect that eventually these products will become profit margin positive or positive contribution to SoFi's business overall. In the near term, they're generating losses. Longer term, they expect. And they say that's through improved unit economics and scale without going into too much detail as to how they expect this to happen. One way this could happen is the more customers SoFi attracts, the more banking customers SoFi attracts, the easier it will be for SoFi to have these customers go into credit card and investment products. If a customer is already a SoFi customer, it won't be as expensive to get that customer to sign up for a credit card or investment. you just send that customer emails, or you probably have their phone number, you have their mailing address, you can send them material, and it will be less costly than if you're trying to attract a brand new customer that's not in SoFi's ecosystem. So as SoFi adds more members, and it's now reached over 8 million members, it'll make it less costly to attract credit card and investment customers. Now, moving on to the technology platform. In that latest quarter, they exceeded 94 million in revenue, representing 21% growth. The tech platform contribution margin was 33% compared to 32% in the previous quarter and 19% 1 year ago. So year over year, a big jump in contribution profit margin for SoFi's tech platform. Now, demand from traditional financial institutions and clients in non-financial categories remains strong, although SoFi did announce that growth in this segment will be lumpy. Getting a new customer takes time, and it's a deliberative process that could take months or even over a year to finally get that customer to switch onto SoFi's technology platform. So growth might be lumpy, but it's heading in the right direction, and SoFi expects this will continue over the long term. And lastly, moving on to its lending strategy, they say they've taken a more conservative approach towards originations, given their concern around rate uncertainty and the broader macroeconomic climate. Let me elaborate what they mean by this. So, the Federal Reserve, the central bank in the United States, has increased interest rates by roughly 500 basis points over the last couple of years. And they did that to put a lid on inflation. When the Federal Reserve increases interest rates, it has the impact of decreasing economic activity. That's because everything you buy that requires financing, things like cars and homes, if the interest rate is higher, your monthly payment is higher, and so you're less inclined to make that purchase. So it decreases economic activity, because if you don't buy a car, you're not going to buy car insurance, you're not going to go out as often, you're not going to do many things, right? So it leads to slowing down the economy, which leads to lower inflation. But that also leads to less job growth, it leads to more job losses, and when people lose their jobs, they may not make their payments. And so that's why SoFi has been more cautious in making loans, because they fear the side effects of the Federal Reserve's policy of increasing interest rates. So far, thankfully, the economy has performed really well in 2024. So that impact from higher interest rates wasn't as bad as expected. But SoFi is still being cautious. They're not saying, oh, it's all good now, clear signs ahead. They're still being cautious. And for the first quarter, they still generated net revenue of 325 million, which was flat year over year. Flat, meaning it didn't grow year over year. Now that's better than expected. Coming into the year, SoFi told investors that their lending business would decrease year over year by about 5 to 8 percentage points. Maybe the second, third, and fourth quarter are going to be much worse, or they're going to decrease their lending activity even more for Q2, 3, and 4. But so far in Q1, flat is better than expected. So in this segment, much better than SoFi thought it would be. And going forward, it remains to be seen if they'll keep this conservative outlook, even if macroeconomic conditions continue performing better than expected for 2024, which has been the case so far. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.